Yeah, I think there are a couple different components to this. So there's a Swift component and there's the frozen bank reserve, like the frozen sovereign reserve component, which is for sovereign wealth funds and the large pools of capital that defend their currency. That's actually probably the bigger story for them. And so if we break it into two parts, it's been long known that countries can be cut off the Swift system, which adds a lot of friction to their ability to participate in global markets, right? So Swift is a lot of people think that's the actual bank connection, but that's actually just the communications system between banks. But basically, if you're cut off from that, it's much harder to transact globally, and that's long been used against rogue states. North Korea, Iran. It's kind of like the quote unquote nuclear option for financial sanctions and things like that. The idea of using it against a country as large and due to its commodity production is strategically important as Russia was not something that was, most people had on their radar, a year ago, including myself. The idea that Russia would be this aggressive and that the West would turn to this level of response against it. So that's kind of a new attribute of this. But that's long been well known that it's possible. The Probably the more interesting thing in some ways is the frozen reserves, right? So countries in the world have to hold reserves in order to backstop their currency, especially if they're emerging markets where their currency is not really in high demand globally. And so what they do is that during good times, they build up reserves. They have accumulated trade surpluses or other, they can also sell their currency to get, foreign currency, and they build up these reserves when times are good. And that can include gold, that can include, dollars, that can include euros, and it could be in the form of bank deposits or it could be in the form of sovereign bonds, often a mix of both. If they hold gold, some of them hold it in their own jurisdiction. Other ones just have it on deposit in London or in New York, which is maybe not the best idea. And so when you have a bad time, when nobody wants your currency, when trade's drying up, when you're kind of in like a inflationary spiral, one thing they can do is sell their reserves in order to buy back some of their currency and basically backstop their currency. And the the whole idea is that that is your accumulated trade surpluses. That's like your sovereign reserve, and it's supposed to be relatively untouchable. You want it to really be kind of like a bulletproof reserve. Um, but if you're basically what the world found out is, they've kind of historically been rather diplomatically immune. Afghanistan's was confiscated, right? But that didn't really shock too many people. That's small and an extreme situation. Uh, People still brought up kind of human rights issues around it because, of course, you're kind of indirectly stealing from the people of Afghanistan, let alone just the government themselves, which is obviously a different story. But when you now kind of confiscate or freeze, I should say, a large country's reserves, that kind of put this on a lot of people's radar. They're like, wait a second, that's possible? That's actually something that countries are willing to do because basically all of those assets, or vast majority of those assets, it turns out have counterparty risk. And people always knew they had counterparty risk, but didn't really know it, meaning they didn't think they'd actually be frozen, at least for any sort of large country. And so if you hold treasuries, if you hold euro denominated bonds, if you hold currency in foreign bank accounts, those countries can freeze it. Even if you hold IMF SDRs, they can be frozen. And so some of the only things that can't be frozen are gold held in your own jurisdiction, or theoretically, if they were holding something like Bitcoin, but of course that's too small and volatile of a market for a big country like Russia, at least at the current time, or by having sufficient diversification so that, if one area freezes your currency, another area might not. And so, for example, if you have yuan deposits, maybe China won't freeze your assets, even if the West will. And so we kind of saw that playing out where Russia still has their gold reserves, they still have their yuan reserves, but their dollar and mostly euro reserves are frozen. And so basically, we're seeing kind of the system. The whole idea of a treasury or a dollar is that it's supposed to be nominally risk-free, meaning that you still have inflation risk, but you have no risk of default or confiscation. But now, if they're not risk-free, if there are disagreements globally, if reserves can be frozen, that theoretically decreases their perceived value among countries, especially the U.S. over the decades. There's various kind of rotating characters of who we don't like at the moment, and sometimes that's justified, sometimes it's not. There's all sorts of reasons, but essentially, if some country wants to be as kind of sovereign as possible, as independent as possible, and make its own decisions, they now have to seriously consider the counterparty risk of all of their reserves outside of, fully self-custodial assets.
But Lynn, would you say that perhaps holding US dollars in reserve it may becoming a bit more risky?
I think that's essentially what I'm saying. Yeah, basically that in addition to inflation risk, there's now counterparty risk, unless you're just in a complete agreement with Washington and a complete agreement with Brussels. Um, and so we actually have kind of a twofold factor. So one is if you look at the long-term chart of inflation-adjusted treasury yields, that's already been making the case for quite a while not to hold treasuries, right? So at least unless you're an active trader, you're getting in and out, sure, have fun with it. It's a trading sardine. But if you're trying to actually hold it as your long-term reserve, that's becoming increasingly less attractive. So there was a period, say, in the 80s and 90s and early 2000s where you were getting a yield that was higher than the inflation rate. But as those yields have come down, we've been, ever since the global financial crisis, especially, the yields have been most of the time below the prevailing inflation rate. And that, of course, really blew out over the past year and a half. And so, in addition to holding what are essentially melting ice cubes that have inflation risk, now they also have counterparty risk. They can be frozen, they can be taken, and so there's multiple risks there for holding those assets compared to holding gold or holding other kind of inflation adjusting self custodial types of assets.
All this kind of leads to an article that I saw on your website, Lyn Alden Investment Strategy. The article was titled "What is Money Anyway?" And you mentioned humanity's definition of money has changed significantly over the centuries. What causes the definition of money to change?
So part of it is technology and part of it is political power, right? So historically, with commodity monies, basically you'd have different types of commodity money. So some cultures would use shells, some cultures would use something else. And when technology improves, we figure out how to make more of that type of money. We say, okay, now, our fishing boats are way better. We can go out, we can get like a ton of shells and devalue them, right? So we basically humanity's constantly searching for the hardest type of money, the one with the highest stock to flow ratio, meaning that we can't really bring a lot new to market compared to how much is already distributed throughout the market. And over thousands of years, the two that really hold up are silver and gold, especially gold. That's the one that, like, if you look at a century-long chart of the estimated gold inflation rate, meaning that the amount of new gold created every year compared to the estimated amount of above ground gold, it oscillates around 1.5% per year with a very narrow band of 1 to 2%. It's actually like impressive to look at. And that's because it's basically a very high stock to flow ratio asset, and there's a built-in difficulty adjustment because as over thousands of years, as we've gotten better at mining gold, we've also mined the easiest deposits of gold. So it's kind of like the gold is getting harder for us to mine to keep up with our technology. It's the only, along with perhaps silver, it's the only commodity that's really kind of maintained that. Now we also have super rare commodities like rhodium, but because they're not widely held, they're not liquid, they're not fungible enough. They don't really serve that role as money. So kind of gold as the highest stock to flow ratio commodity has been the one that's been resistant to debasement over thousands of years. And so that as you kind of have this pyramid of almost like a March Madness chart of all these different commodities kind of competing for the top slot, and it was gold that proved to be the most resistant to debasement. But the downside of gold is that it's not fully portable, right? So it tends to be centralized. And then so we had countries kind of issue, they would centralize it in bank vaults and then central bank vaults and then issue notes against it. And then of course what you can do then is end redeemability or devalue redeemability for those notes relative to gold. And so as we shifted to more of a fiat-based standard, we shifted away from commodity money and towards fiat money. And that's where after technology, bring in the second part, which is that kind of political power, geopolitical power, kind of shifting roles of power. And after World War II, the U.S. had by far the world's largest navy. We had something like 40% of global GDP. So the United States could go to different countries and just basically make deals with them, kind of like deals you can't refuse, sort of, and say, okay, so we're going to give you protection from other entities and ourselves in exchange for you using dollars as, say you're only going to sell your oil globally in dollars, or you're only going to sell this in dollars, and you're going to hold your a large portion of your reserves in treasuries and dollars. And so, due to the fact that we're the large, the Navy that can really kind of defend global supply chains, and due to, just that global reach, we've been able to maintain that system. And essentially, what it is, it's the dollar backed by oil, but not really pegged to oil, right? So globally, because OPEC's been only pricing their oil in dollars, everybody around the world thinks in terms of dollars, needs dollars if they want to import energy. And then on top of that, we layered the euro dollar market, which is basically the debt markets. So, that kind of petrodollar system kind of kick-started the network effect. But then on top of that, all these countries took out debt in dollars, right? So if say Brazil, a company in Brazil wants to borrow money, there's some investors that maybe are willing to lend in local currency with high rates. But if they want lower rates, or if there's a problem with the currency at the time, it's often done in dollars. So a lender in Europe might lend to a borrower in Brazil in dollars, even though none of these are Americans, right? So and because that system is in place, all of that dollar-based debt represents demand for dollars. And so, for example, the Bank for International Settlements estimates that there's $13 trillion worth of U.S. denominated debt in offshore markets. And it could be higher than that. There could be derivatives and other things that bring that number higher. And so all of that represents demand for dollars globally. And so what essentially is a large network effect that has kind of displaced commodity money. But the challenge now, of course, is that as debt has built up higher and higher in the system, the inflation adjusted yields are getting lower and lower. And as you have kind of the world building out, so as you have the rise of China, as you have kind of, the U.S. kind of diminishing its role as the biggest commodity importer. Now it's number two. And as you have, you're going down from, say, 40% of global GDP down to 20% of global GDP, the world's more diversified. We're seeing challenges to that really centralized system of having the treasury and the dollar at the heart of the reserve system, as opposed to something like gold.
If you're enjoying this interview with Lyn Alden from Lyn Alden Investment Strategy and I, please consider subscribing to our YouTube channel and giving us a thumbs up to let the algos know you want more content like this. And if you want to learn more about systemic wealth protection, please do visit us at www.silverbullion.com.sg. In that same article, you listed money in three categories. We have commodity money, we have fiat money, and we also have digital assets. However, it looks to me though that commodity money and digital assets, they're both kind of on the fringe where perhaps they may even merge. So I'd like to ask you, what type of money do you see as being the money of the future?
So I think we are getting more digital. And the thing about digital is that it kind of like there's digital versions of all the things we just talked about. So for example, you can have digital fiat where, in some ways fiat's already been digital, but at the back end it's still going through kind of legacy bank pipes with each other, right? So a digital money is something like a stable coin where, basically you deposit fiat at a custodian. They give you a token that is redeemable for that. And unlike a bank deposit, you can then take this token and just trade it among your peers, or custody it. Now, it still has centralization risk because you're still relying on that counterparty, but basically it's more automated, and it's more kind of diversified. There's more kind of payment channels. Now, they can still blacklist that token, so they can say, okay, because that token was associated with money launderers, it's no longer redeemable, right? So there still is that reliance on a central custodian similar to a bank, but it is basically better technology, more automated. So there's that option. Then you can, of course, nationalize that and make like a central bank digital currency version of that. From policymakers' perspective, they like the fact that they can ban cash, they can surveil transactions, they can implement negative nominal yields, they can do sort of things like that. But of course, from the user perspective, we don't particularly want that. And so, all sorts of privacy concerns, control over our transactions. So those represent kind of digital versions of fiat, and they still have the same problems of fiat where they're debasing. They have all sorts of issues like that, but they're backed up. They're backed up by tax policy and existing debts. So they have those existing network effects of usage. Then you can do things like you can make, for example, gold into a stable coin, right? So you can, and that those exist now. So you can have a token that represents, it's redeemable for a certain amount of gold. And that kind of, competes now with the ETF market and other markets like that, because you have certain advantages and of course certain disadvantages as well. You still rely on that counterparty risk. You still have that centralized risk that token is going to be honored for redemption of that gold. You don't hold the gold yourself, but you have a claim on it. And so it has the same problem with other claims, but it's a better technology form, and it depends on how much you trust it. So for example, if say a shady company, if JP Morgan issues that, you might trust it less than if Sprott issues that, for example. And so you'd have to evaluate your understanding of that counterparty and the probability that they will honor that and that their local jurisdiction will allow them to honor that. And then you have, for example, things like bearer assets themselves, like Bitcoin, where it's, a Bitcoin is not redeemable for anything. It just is a Bitcoin. And what people are buying into is a share of the network. So there's 21 million coins. They're divisible into 2.1 quadrillion partial coins, and people can own a stake in the network. And essentially, what that gives them is the ability to transact in a way that can't really be blocked or censored easily. So there's no counterparty that can block the transaction. There's no centralized counterparty that can freeze Bitcoin addresses. Now they can do things like they can say, okay, these Bitcoin addresses can't go to centralized fiat exchanges and get converted back into fiat, at least in these countries. So there are ways to add frictions to it, but unless you can control 51% of the miners, it's impossible to censor transactions. And so basically what these do is they reintroduce commodity monies, fiat monies, but in kind of this native digital form. And you even have now, for example, digital equities where you can have like proof of stake systems, governance tokens, things like that, where there's some sort of system out there, and then your tokens represent voting rights into that system, or that you can be airdropped proceeds from the operating of that system. And so basically, what we're seeing is the emergence of digital commodities, digital fiat, digital equities. Now that technology's kind of reached that point.
Fair to say each one has its pluses and each one has its minuses.
Exactly, yeah. So I mean, say with something like, you know, digital fiat, so stable coins and central bank digital currencies, the advantage of stable coins is that compared to existing banking rails, they're much easier, right? So ask anyone that sends stable coins internationally compared to anyone who tries to do international wire transfers. It's just easier, it's cheaper, it's better in most cases. Whereas the downside, of course, is that the custodian can still censor it, if they really want to. In addition, you're assuming that their collateral is being managed properly and that it can fully redeem the tokens, right? So if I give dollars to the entity and they give me stable coins representing dollars, and if they go and gamble all those dollars in Vegas and they lose them, or they, more realistically, if they do something with derivatives, if they invest in something risky and it blows up and they don't have the backing anymore, then my token can be impaired, or in worst case scenario go to zero. And so generally, again, it comes down to counterparty trust. If they are audited to only hold their reserves in dollars and treasuries, for example, I can say, okay, this is a pretty significant backing, right? Or if they hold it in diverse assets, but like a bank, they have a capital buffer. So if they hold 110% assets, and most of it's pretty conservative, I can say, okay, there's a reasonable chance that this is going to be, redeemable for the foreseeable future. But because you rely on that counterparty risk, and because it's pegged to a dollar, which is devaluing, those have their intrinsic downsides. And then of course, as you get to central bank digital currencies, you get into privacy issues, control issues, things like that, especially if you are in a jurisdiction like China, right? So it kind of would depend on what jurisdiction you're in and what they want to do with the currency. And so all of them have their own pros and cons, and essentially what it is just kind of everything's faster now, right? So kind of the question of what is money. Monies used to change very slowly over time. Using that process we talked about, new technologies would make some monies get devalued, other monies would be harder to devalue. Then you'd have the introduction of fiat, and now there's this kind of fast digital marketplace of monies, and traders can, there's all sorts of pump and dump schemes. There's all sorts of kind of scams that can happen in that. And then governments are at different paces of getting into it. So China's been investigating it since 2014. and they've been working on their central bank digital currency, where other governments in, say, the United States and Europe are just kind of over the past year starting to look into it pretty significantly. And so there's a spectrum of how quickly different entities are getting into the market, and it's kind of this rapidly adjusting market. And so consumers have to be very careful with the different types of assets out there because a lot of them have really bad track records.
Is it fair to say that throughout history, we see how debasing and an unbacking of a currency seems to always put us on a path of debt, of destruction, and even wars?
That's the general pattern. And one of the, one of the big risks over and over is basically relying on counterparties. And of course, basically the trade-off is that usually relying on counterparties is more convenient and simpler, but then it comes at the cost of a risk, especially every couple decades. So the reason we do it is because it kind of comes in these long cycles. So there are periods of time where it's totally fine to rely on counterparties, and then almost overnight, a lot of the counterparties default or debase or change the rules and things like that. And so you go through these cycles, and you know there's even times where you're not, you have to rely on counterparties. Basically, the law says you can't own gold; you have to own banknotes that represent gold in some sort of abstract way. And so different, consumers in these different markets go through these cycles, and it's particularly challenging for people in emerging markets because their currencies have a tendency to devalue. They go through these periods where even though they could be stable for a decade, and then they could break a peg, and they could, a number of them have hyperinflated, right? It's actually hyperinflation in developed economies is rare. The classic examples, Weimar almost 100 years ago, whereas in emerging markets, you know, over a 30-year period, there's been like dozens and dozens of hyperinflations. It's a common occurrence, unfortunately. And so the risk is that people store their money in something that looks fine for a while and then breaks.
A lot of interesting communique has come out of Russia as a result of the sanctions. And first, I want to get your thoughts on Putin's unfriendly countries where he wants them to pay for gas in rubles. How likely is such a move, and what impact will it have should it become a reality?
So we're starting to see that's a quickly moving news situation. So that could change in a week, but essentially, we have initial resistance, obviously, from countries willing to do that, and then we seemingly have countries more willing to discuss it because Russia is, threatening gas contracts if they don't come to the table and discuss that. And essentially, what it is a ploy to defend the currency, right? So especially when you're in an emerging market and there's not a lot of global demand to hold your currency. Um, they don't fully trust the rule of law there. They don't, maybe you're a small share of global GDP. Um, so you generally need a reason for them to want your currency. And normally the reason is that you're running current account surpluses and you have sufficient foreign exchange reserves. So people trust that the stability of that currency is pretty significant. But if the country's heavily sanctioned, if their economy is impaired, if their exports are diminished, that can result in a death spiral for that currency. Now, Russia is pretty critical to the world in the sense that even though it's a small share of GDP, the GDP is kind of essential commodities that people need. And so they have that going for them, but of course it's offset by the fact that their economy is impaired because of all these war sanctions, right? So one of their ploys is to say, okay, if you want to keep buying our gas, you have to buy it in rubles, which theoretically would create demand for rubles. And so far, they've been able to somewhat stabilize the ruble from its initial free fall during the war. And I think a part remains to be seen. What are they going to do with their continued aggression? Are they going to keep pushing, or are they going to kind of, fall back at some point, kind of, make peace agreements? And then two, to what extent is the rest of the world going to have an energy crisis and then have to keep not doing energy sanctions, keep buying energy from Russia, keep buying their other commodities, and then start kind of making deals that kind of are somewhat favorable to Russia. So it's kind of, each side kind of has a gun to the other's head, right, geopolitically, and we're kind of waiting to see which one plays out quicker. So Russia's economy was impaired quicker than, say, Europe's economy was impaired by commodity shortages and price spikes. But the longer that goes on, it kind of remains like both sides are being heavily hurt by that, maybe to different degrees. But if the commodity market gets problematic enough that then that kind of does give Russia some leverage.
Yeah, because on the flip side, for countries that Russia sees as friendly, they're considering accepting Chinese yuan, Turkish lira, even Bitcoin for trade, for gas payments, even gold. Are we seeing a paradigm shift towards a world without the dominance of a dollar, or perhaps a dual reserve world currency?
Yeah, something I've been writing about since 2020 is that the reserve system and the global payment system is becoming more diversified and is likely to continue to becoming more diversified. And what I mean by that is when people talk about, say moving past the current dollar standard, they're saying what fiat currency is big enough to replace it? And my answer is none. There's no, the yuan's not big enough, the euro's not big enough. There's no individual fiat currency anymore big enough because that was a unique situation back in the after World War II and then in the beginning of the 70s, when you're 35 or 40% of global GDP and you're the biggest commodity importer, then you're big enough to be the heart of the whole system. Whereas if the biggest economy in the world is only 20% of global GDP, it's really hard to be the one currency that backs the whole system. And it even has costs for that country because they run, the US runs these huge structural trade deficits basically in order to support the system. So we have advantages from the system and we have disadvantages from the system. And so as we go forward, my expectation was that, due to increasing technology, including what we just talked about with, digital payment channels and things like that, and then two, the increasing recognition that treasuries are going to persistently yield negative real yields, negative inflation adjusted yields going forward, that countries are going to want to diversify more, both in terms of their payment channels and their big pie chart of assets that they hold to backstop their national reserves. How concentrated do they want those to be? And what percentage do they want in fiat currencies? What percentage do they want gold and other assets? And so I think over time we are going to see a more bifurcated world. You have the United States, you have China. Those are kind of right now the two biggest economies. You also have the rise of India. Europe's still a very large player, and to the extent that different countries can make alliances, right? So if Russia and China can hold some sort of alliance between themselves, in some ways they shore up each other's weaknesses because China is a manufacturing powerhouse. They're decent with technology, but they're short commodities. They need to import commodities in most cases, whereas Russia is kind of the opposite scenario, right? So they're good in aerospace technology, but they're not a large manufacturing hub, but they do have commodity exports, and so there's a kind of a natural alliance to the extent that they are able to make that work. And so I do think over time we're going to see increasing diversification of global reserves and global payment channels because it's less of a unipolar world and more of a either a bipolar or a multipolar world over time. And one of the winners of such a scenario is neutral reserve assets. So assets that countries can hold in their own jurisdiction that are scarce in some way and that are harder to be blocked and censored. And so that gold is kind of the main asset right now, right? That they can turn to, and then they're down the road, if something like Bitcoin gets bigger, they can explore that. Some of the small countries can already explore that, but right now, even the gold market's barely big enough to increase its share unless the price goes up quite a bit, right? Let alone what would have to happen to Bitcoin if that was kind of used in any sort of meaningful way there. And so I think we're going to see more diversification and more emphasis on neutral reserve assets like gold.
Do you think we're in the beginnings, or we're at some point in this monetary reset, as some people like to call it, where we're seeing the dollar being challenged?
So I think this is a long process, and there can be spikes that happen in the process. Like, so for example, I would describe this entire war, in addition to all the humanitarian concerns, it's a kind of acceleration of some of the stuff I've been talking about for a couple years, and that acceleration was in some ways like I didn't foresee that this would all happen in February, March of 2022, and that this would happen, and that this response would happen. That's all kind of that sort of that new component that accelerates certain things. So you can have it's like that phrase like there are weeks where decades happen and there are decades where weeks happen. So I mean this was obviously a period of weeks where like maybe decades worth of global financial plumbing changes happened in a rather short period of time. They were accelerated. Um, but I think essentially the dollar, there still is a lot of debt for the dollar, which represents demand for the dollars. It still is, a huge importing country, and so it's not like a light switch goes off, and 6 weeks from now that no one wants the dollar anymore. You'd have to have a pretty significant event for that to happen. Instead, I think we just see you have to watch the percentages over time. What currencies do countries hold their reserves in? What's happening with things like the gold price, and are they changing their practices towards gold or not? And I think that's something to watch over time. I think this is you can have these rapid shifts, but it's also just a process playing out.
Do you think the time is ripe for a neutral reserve asset like gold to come back on the table where countries will start to trust each other's currency once again?
I think so. And really, if you look back since the global financial crisis, there has been a shift. So for a while, gold reserves of countries were going down. The UK famously sold some of their gold, roughly at the bottom, like 20 years ago. And really, ever since the global financial crisis, and then in the years that followed, there's been kind of a re-emphasis on gold around the margins as a neutral reserve asset. And so I think that if anything, this might have accelerated that to some degree. And so I think that trend is still going to be intact, where they'd rather buy gold than continue accumulating treasuries. And they can accumulate both, but they can accumulate more gold than treasuries rather than literally sell gold and buy treasuries, right? So I think that the share of gold, both through a combination of purchases and through appreciation of that gold relative to dollars, is likely to make those reserves a larger share of their effective assets over time.
Okay, Lynn, you gave a lot of great info here, but not to give away too much of your hard work. With so much uncertainty going on and in the air, what investments or resources are you looking at moving into or maybe looking to move out of?
So I am still bullish on gold as an asset. I have been since 2018. There's obviously periods of time where it's better or worse than others. I do like Bitcoin as well as a more volatile but potentially higher returning play along similar lines. I also like, in general, commodity companies, because even though we've seen like say a spike in oil prices, oil stocks are still, kind of priced for lower oil than it currently is. It kind of assumes that this spike is transitory, it's going to come back down. Whereas I think the longer term kind of pricing for a lot of these natural resource stocks is still very attractive. Same thing for pipelines and same things for value stocks in general. So I think a diverse basket is still kind of a useful way to play it.
All right, Lynn Alden, before we wrap up, can you let the viewers know how they can follow you and get more of your views, services, and strategies?
I'm at lyndalden.com and I'm at Lyn Alden Contact on Twitter.